We'll be discussing today this is the third chapter of our report. Basically, we will discuss the LDC graduation as well as the recent tariff hikes and impact on LDCs, basically. And we will show some numbers, some simulation results. We will see how that actually, in a sense, given the timeline that we had, how it looked by September 2025. So let me move. Okay. Today's presentation, I will have the first part. I will discuss the impact on LDCs. Basically, we will see how the graduation could be very traumatizing, could be very damaging, unless the countries prepare well for the transition period. And secondly, I will also discuss the impact of US tariffs started in April 2025, and how it has a asymmetric impact on LDCs. And the final part will be presented by my colleague Federico on the way forward and some conclusions, what we see and what could be the prospect in a new evolving world economy. What are the options that we have, or developing countries can have? First part is about LDC graduation. Out of 44 LDCs, 14 are in the process of the graduation at different times, different periods. So we all know that LDC graduation is based on certain metrics which depends on their income level, their development level, which is in human capital, economic resilience. So once the country actually qualifies, they go through certain processes, formalities. But then the danger is once they lose that status, actually that means certain preferences which are very generous in general, LDC-specific preferences will be gone. They could actually lose quite significant preferences if it is only option they had at the time. So currently 25 economies are offering these kind of preferences, and we will show the impact on LDCs. So these are the countries that we see in the process of graduation, and they spread across the world in different places. We have Asian economies like Bangladesh, Cambodia, Laos, which is about to graduate. And we have some African economies as well, Senegal, Djibouti, etc., and also Oceania as well, Solomon Islands. So what we did was we ran some simulations, which is done by ESCAP and ECA, and it is called TINA. This will be the platform that we use for both LDC graduation impact and as well as the US tariff impact. It is so it's basically we take these economies and we can see what kind of trade agreements they are part of, they benefit, and we just take out the ones that are specifically for LDC. So if they have the FQF, duty-free, quota-free, it may end up going to MFN. If they are benefiting from LDC-specific preferences, they may go to general GSP after graduation. So this program actually takes into account the second best, alternative they can qualify. So, okay. Sorry, I went too far. Is it? Okay. So these are the first the slide I want to show about the impact, and we run the simulations for all countries, but this TINA platform actually uses Comtrade, which sometimes doesn't have the complete data set. So UNCTAD stat figures and Comtrade may diverge because UNCTAD stat includes estimates for countries that doesn't report, that doesn't have the full trade matrix. So because that discrepancy, we narrow down to 10. So we see that from that graph, the impact can be substantial, especially some Asian LDCs like Bangladesh, and also, Bangladesh, as well as Myanmar, Cambodia. So it can be as high as 32% in the case of Bangladesh. It could be between 16 and 70% for the other two, Myanmar and Cambodia. And some others, however, it could be much less. For example, if we look at here, Nepal and Solomon Islands, and also Angola, which we didn't use it because of the data glitch that I talk about, the differences. They also have smaller numbers. So it is not uniformly the same impact. Some are more susceptible to these preference changes. And as you see, Bangladesh is 18 billion and 32%, and others like Myanmar, Cambodia is $4 to $6 billion. And one of the reasons why we see such a difference impact is because which countries they are more exposed to, how important these markets for them. For example, EU. In some economies like Bangladesh, EU market is very important. And once these preferences are lost, it could have an impact because they depend on these markets significantly. In general, for example, these 25 markets, which includes, just to summarize, EU, Canada, US, Japan, preference programs, as well as India and China, which is also offering LDC-specific tariffs. So these countries tend to have high share in the exports of these graduating LDCs. So higher the exposure, higher the impact. However, this is not the directly one-to-one relationship. It is possible that even though countries like Nepal has high share or have exposure to these markets, they don't have that much impact, the simulation finds. So that means they kind of have alternative trade deals, trade agreements, in case LDC graduation eliminates the preferences. So this is, from a country perspective, where the impact is coming from, where the decline is coming from. For example, in this table, we see for Bangladesh, the first row, EU is the majority, 72% of decline is coming from EU market. Because Bangladesh, I will show in a minute that apparel is very important, and apparel preferences will be lost after graduation because moving to everything but arms to the general GSP, they are gone. So some others, also the EU has been important. You see the EU has been the biggest loss in case of graduation for Myanmar and Cambodia. But some others is not the case. For example, in the case of Tanzania, we see India is the biggest loss market. Or in Laos, it is China, or Senegal is also again China. So we see some mixed picture that in 4 economies, EU is the biggest market lost in terms of the share, and China in 4 others, and India in 2 other economies. So depending on the importance of the market, the strategies of the graduating LDCs could be different as well. As I told you, for Bangladesh example, the biggest thing is high exposure to the EU and high share of apparel products, footwear products, which has been the high risk in terms of trade loss. This is Bangladesh as again an example. You will see that the 97% of the decline after graduation actually in 2 products. They are apparel, the 2 codes of different apparel products. So that means they have been not diversified in terms of the EU market, in terms of the product. So once that preference is lost, it puts in a huge trade impact is coming from that. And there's GSP Plus, but GSP Plus is not guaranteed. You have to actually comply with certain international rules, which is a kind of a long process and is not easy for many graduated LDCs to comply, all of them. Going forward, and this is a graph that shows how these LDC graduation depends on the exposure to markets In this graph, you will see all 10 economies, and in the horizontal, you will see the share of 25 markets, the preference granting markets. On the vertical, we see impact in terms of percentage. So if we go down from vertical, that means bigger impact, biggest negative impact. So expectedly, it's a negative slope line. That means more exposure, more impact for the countries. However, as I told you, in Nepal, this is kind of a different structure, different case, because they have an important trade partner, India. They have a South Asia Free Trade Agreement. So in case of elimination of preferences, they could have an alternative trade deal that can still give them access to an important market. Another is Angola, for example, which I didn't put. The reason why it had a low impact, because in general, the fuel or commodities in that sense are subject to low MFN rates. So preference loss would not mean too much for some economies that have been exporting commodities. Also, we have actually Solomon Islands that I found that they also have a small effect because the major trade partner like China already, the timber, I think, has been an important product. It's already, MFN rate is very low, so losing preferences doesn't make a big impact. So impact can be very high if you are not diversified much in terms of markets. If you are relying on couple of markets, and also product-wise. What can be done? One way is to prepare for the after graduation. For example, in the Bangladesh example again, we have seen they have been negotiating or talking with FTAs with Japan and Korea, Republic of Korea, and Singapore. Solomon Islands, even though they had still low risk in terms of losing the preferences, in terms of trade impact, they also negotiating with China in terms of another FTA. However, FTAs are not the same as non-reciprocal trade preferences. Why? Because you have to open your market. Like in the case of EU-Mercosur trade, Mercosur countries had to open their markets, especially which ones that the European businesses has interest, like it could be auto industry, it could be services sector, some sectors that have interest. So that could also mean the more competition in domestic market compared to non-reciprocal case. And also that means revenues, tax revenues will be lost. So for LDCs, that's an important element. Tariffs are a source of income, that giving up that. However, given the circumstances that we are discussing about graduation, those are the venues that countries can see and try to prepare themselves. And also, not only market, but product-wise. As Alessandro earlier mentioned as well, the services has been a very dynamic part of trade, international trade. It has been growing much faster. It has been, I think last decade is 5.3%, which is double the merchandise rate. So, and also it's 27% of the world trade now. What does it mean? This is the one that is more dynamic, not only for services, but for everything, for goods as well. Because services actually in 71% of the value added of intermediate goods. So that means it enters everywhere in the production process. And if you want to keep your competitive advantage, you need to have services that needs to be very efficient. Because you need to have you cannot rely on the price competition. For example, if you offer something coming from one company which is $10, the other one is $5. What you don't only look at the price, you look at how the services are after the sale. That is services. And also you look at the design, how it looks, the quality, how it can stay competitive over the longer time. So services has a critical position in terms of keeping the moat, keeping the brand of the companies. So that's why it is important, that's why it shows up everywhere. And it is becoming more important than ever, actually. And then the second part will be on the US tariffs. These are preliminary results, I would like to say from the beginning. So as we all know, in April 2025, US government imposed blanket reciprocal tariffs and also some adjustment based on their trade balances with the countries. What it did was it increased the tariff exposure of LDCs, and it broke one of the most fundamental principle, special and differentiated treatment of LDCs. So it didn't differentiate whether they have a capacity to adjust or capacity to really trade with those tariffs or not. And I will show that that has showed up in the simulation results. Imposing same tariff would have a significantly much bigger negative impact on LDCs than others. So, as I told you earlier, we use the same platform, TINA, and what we did was we use the trade figures from January to September 2025 for the analysis, because that is the deadline for us to complete the report. So these are the initial tariffs, and it evolved over time. Just I wanted to warn you that these are the initial peak. Eventually, there was some moderation in the tariffs, and some of the programs which were not there actually restored later as well. For example, AGOA, and so it's the impact is based on initially announced figures. So we use our trade dashboard, which was released at that period, to track the changes. And we see this on the graph that across the board, like the first one was LDCs, the second one was developing countries, and the last one on the graph are developed countries. So across the board, we see a significant increase in average tariffs. So it was more close to each other, but then there's a significant jump. And even when we look at the increase, it's from 1.7 to more than 13% for LDCs. And not only that, it increased was much faster in terms of the increase for LDCs than the developing countries. So it's kind of asymmetrically more damaging in terms of the costs for the exporters. And I wanted to show not only that LDCs face higher tariffs, but they didn't face the same tariff. It has created some kind of gap, inequality in terms of tariffs they are facing. If you look at this graph I put, it shows from the highest to lowest after the adjustment by September 2025, these countries has been facing. So countries like Myanmar, while facing up to 50%, Laos 38, Bangladesh 35, some of them on the bottom of the list are facing almost zero, like 1%, 2%. So it's creating inequality among the countries that are similarly fragile or similarly exposed to structural issues or development challenges. So what are the reasons for that? Because first of all, it depended on their export basket. If you are a commodity exporter, MFN rate is already low, so it wouldn't affect you, and it was excluded as well. So like Angola and Congo seen smaller increases, while the others who are manufacturers had the more domestic productive capacity in the manufacturing actually faced asymmetrically more tariffs. So then what does it mean? It creates inequality. If we look at this graph, shows the countries from the left is the LDCs that are facing the lowest tariffs. And on the right, if we go towards the right-hand side of the graph, we see LDCs facing the highest tariffs. So the gap between the inequality, lowest tariff facing, the highest tariff facing, high tariff facing countries, it used to be that gap was around 5 percentage points. So it was not creating inequality among the LDCs or different treatment, let's say, maybe because of their export composition. But after this shock, the gap was 20%. So it created incredible difference treatment or incredibly different impact on their export potential. So Not only that, poorer the countries, higher the tariffs they could be facing in that respect. Then the impact. The TINA we use to estimate the impacts. Actually, TINA colleagues in ESCAP has already done and put for, I think it's around 110 countries. So we compiled and summarized the simple averages by country groups. So this graph you see is actually the summaries, averages. So on the left-hand side, we see LDCs, the middle is developing countries, and the right is developed. So we see that even though, if you remember the two slides before, they kind of had a similar rate of increases on average, the blanket tariffs, but the impact has been much more negative for LDCs. 45% exports to the US were simulated at the peak period of the tariffs for LDCs, while it is about 25% for the developed countries. So why this is the case, why LDCs has been more impacted, or the simulations are found that one of the reasons is that how easily you can, how diversified your export basket, how easily you can move to alternative markets. Do you have a market power in exporting your products? If you don't have the market power, you actually, that means it's very easily price increases due to tariffs will hurt you. So if you can, in the case of maybe developed countries, you can, first of all, negotiate better deals. That's another thing. But also that means you can have at least carve out some kind of mode. That means your products, your exports has kind of power in exporting market. You can keep exporting because that's more kind of difficult to substitute with others. But if your products are easy to substitute, or if it is concentrated on few, then you will be more exposed. Then this graph also summarizes the inequality impact on the across the countries. These are all countries across the world, and the horizontal axis shows the per capita income in terms of purchasing power parity. So if you go to the right, you are getting richer. If you go to the left, you are getting poorer. So, and the vertical axis is the impact on the exports to the US after the tariff. So that means higher the tariff impact on the poorer countries if you go to the left upper corner. So we see this nicely negatively sloped correlation line. That means poorer countries actually exposed to higher export declines to the US. And actually what we found is out of 5 most impacted countries, 4 of them were LDCs. We identified Burundi, Comoros, Myanmar, and Uganda, according to the simulation results, are the most expected to impact. So it created these tariffs, even though it was blanket, more unequal impact in terms of trade declines. So one of the reasons why these impacts are felt much more severely by some countries, obvious thing is because some of them are highly exposed to US market. For example, Nicaragua, 50% of their exports are going to US. So that has been one of the reasons for some of the economies. So high exposure, so market diversification can be an important way to reduce these costs. And this is all about the tariffs, but I wanted to complement the previous discussions and saying that this is not a temporary glitch. This is not like a one-time, there was an increase in tariffs, now it is moderated. As Alessandro also earlier mentioned, in terms of number of interventions, discriminatory measures introduced over time, as you see, that has been increasing much earlier. That means since 2018, if I'm not mistaken. So it started picking up. So what we are seeing is the global trade policy uncertainty as well as global trade uncertainty has been increasing. This graph shows that over time, across the board, that means in the world, in the developing countries, as well as LDCs, all these three graphs simultaneously, uncertainty picked up across the world. What is more interesting is the source of the uncertainty actually usually from a developed market. It could be from US geopolitical tensions with China, or it could be Brexit or something else, but actually spread to all over the world, even though they were not the source of the uncertainty. So it resonates globally. And as you see that eventually, gradually, it leads uncertainty to all over the world. And geopolitical tensions that we are discussing and more protectionist policies that we have seen in the major markets, as well as the restructuring or de-risking of the global value chains actually having this uncertainty impact. So this is not a one-time glitch, and we see that this economic fragmentation could be damaging for developing countries. It is a very simple correlation analysis on that. And this graph shows the episodes of high uncertainty and episodes of low uncertainty and the export growth, non-oil export growth of LDCs. So on the left-hand side, you will see the low uncertainty episodes that usually coincides with higher average export growth for LDCs. And on the right-hand side, you will see those are the high uncertainty episodes that we see much lower export growth. So, so far, when we see in the last 20 years or so, we see that kind of already impact resonates through uncertainty because FDI won't flow to developing countries because of uncertainty is making businesses not to see their future and also postpone their investments. And as if the companies don't see their future, long-term prospects, they don't invest. And also it makes it difficult for developing countries to integrate to the world trade networks, because if the rules are changing so quickly, and it's very difficult for these economies, which are already have challenges to adapting to these changes, to be attractive in terms of a important trading partner. This is all for my part, and the final part, my colleague Federico will discuss the way forward and some conclusions we derive from our publication. Thank you for your time.
Thank you very much. Thank you very much, Mesut, for passing me the floor. And I would like to thank both Taysugh and Mesut for the first part of the presentation. So we have seen the historical context of trade preferences schemes. We have seen what happens when these schemes are changed, or when these schemes are interrupted for some reason, when basically the preferential access is interrupted. Now, here in the section that I'm going to present now, we are going to look at the way forward. So how non-reciprocal trade preferences can be shaped for the future. But before doing this, I would suggest to do just a quick recap. So, three main points we have seen today. So, first of all, the loss of preferential access translates into substantial export decline for all the beneficiaries. We have just seen now the examples of, for example, the potential impact of graduation on countries like Bangladesh, Cambodia, and Myanmar. We've seen Bangladesh could lose up to 32% of the exports. We saw as well what was the impact of the expiration of the US GSP on the imports. We saw it went down by about 10.5%. So this helps us to clarify this concept and the relationship between loss of preferential access and the export decline. We then see the second concept, which is the impact of the new US tariffs that were implemented in 2025. So we saw that the new US tariffs of 2025 meant that average tariffs on LDC goods rose to 13%. What is the consequence of this? This is that LDC exports to the US are projected to fall significantly. Finally, the last point, we have also seen that soaring global trade uncertainty is posing risk to developing countries' exports and FDI inflows. So, against this background, what are the possible way forward for non-reciprocal preferences? So, first, we could look at improving predictability, stability, and transparency of these schemes. Practically, what does this mean? This means extending the program duration. We have already seen this shift happening in some markets. So longer-term schemes are increasingly more and more common, and this helps to reinforce predictability for exporters. So we know, for example, that Canada and Japan, they've renewed their GSP programs for around 10 years, while the Everything But Arms, so the EBA of the European Union, as well as some other schemes offered by India, China, and the UK, are so-called open-ended, so they do not have an expiration date, so to say. What else? So preference granting countries are also increasingly aligning to offer DFQF market access for all United Nations recognized LDCs. So this means as well a more comprehensive coverage of products. So what do we have in this case? We have expanded country and product coverage. Third point is support for graduating LDCs. This would obviously improve the transition out of these preferential schemes. So already the European Union, the United Kingdom, and Canada have introduced mechanisms allowing continued access to LDC-specific preferences for 3 years after the graduation from the LDC status. This helps obviously mitigate trade disruptions and support a gradual adjustment of graduating countries to new trade conditions. Finally, we can look at enhancing the GSP and GSP Plus and GSP Plus-like schemes. So these reforms in this kind of sense would help improving accessibility for vulnerable economies, including, as we were saying, LDC, like future LDC graduates, and could also represent a positive way forward in this sense. In terms of policy areas for shipping and RTPs for the future, in this case, we look ahead and we see how the international community can broaden the scope of preferential trade by exploring new models that go beyond what we call the traditional North-South framework. So, for example, here, South-South trade partnership and what we call development-oriented reciprocal trade agreements can unlock new trade opportunities. Just to have an idea, between 1995 and 2025, South-South merchandise export have soared from about 0.5 trillion to 6.8 trillion. This means this has far outpaced South-North trade and the overall world trade growth. So this points to the definite potential of South-South trade for developing countries for the future. In this case, partnerships such as the global system of trade preferences among developing countries, what is called GSTP, can help LDCs unlock new trade opportunities. So this is an agreement that currently covers 42 developing countries. 7 of them are LDCs. For example, we were talking earlier about Bangladesh and Myanmar. They're both part of this agreement. And it can provide specifically for demand-based special treatment for LDCs members. So it's already built in the agreement to have special treatment for LDCs, specifically in the form of what is called duty-free access, and especially for processed and semi-processed goods. But also, on the complementary to South-South trade and to, again, this kind of partnerships, there is also North-South free trade agreements that can be made more development-oriented. As Masoud said earlier, as my colleague said earlier, the negotiation and implementation of reciprocal FTAs requires significant institutional capacity and obviously stakeholder coordination. So this could be a challenge for newly graduated LDCs. Finally, another point can be the sustaining of FDI inflows. So sustaining what we call foreign direct investment inflows can also help mitigate the impact of changes in non-reciprocal trade preferences. So, for example, integrating outward FDI promotion with development assistance through, for example, guarantees or financial support or facilitation could help sustain investor confidence and maintain value chains during these transitions. Finally, we can look at enhanced international dialogue, which can help modernize trade preferences. While we said already at the beginning that these schemes are normally been unilateral in terms of, let's say, policy. So it's normally the preference granting countries that establishes the conditions of the schemes, often without sufficient inputs from beneficiaries, creating a structured platform for dialogue, so bringing together preference granting and beneficiary countries can help correct this asymmetry of condition, which would help, obviously strengthen dialogue, shared learning, and support in the future co-design and modernized schemes. One example of such a forum for international dialogue could be the revitalization of mechanisms such as the Special Committee on Preferences, which was originally established under UNCTAD II. So this is a committee that could, for example, its revitalization could support enhanced international dialogue. Then here we look at the policy recommendations. So this is just, to close, to have a recap of what we said until now. We can group our recommendations as follows. So first, transitions from GSP schemes to other schemes due to graduation or other reasons need to be transparent and accounting for the needs of transitioning countries with sufficient notice period, for example, and support for economic adjustment. This is in the idea that smooth and sustainable transition period are essential to safeguard trade relationships, production capacity, investment flows, and these are all elements that have been, let's say, previously supported by non-reciprocal trade preferences. Second, equally important is the preservation and the strengthening of existing preference schemes alongside efforts to enhance their predictability, stability, and security across all markets. Such measures obviously will help offset the adverse effects of preference erosions in any single market. Going forward, as we know that now 14 LDCs are preparing for graduation from LDC status, bilateral FTAs, South-South trade cooperation, new market access cooperation, and supply-side support will emerge as increasingly important and in complementing the GSP schemes in general, the non-reciprocal trade preference schemes, as country will slowly graduate from these schemes. Finally, last point, what we said just earlier, so establishing structured mechanisms, potentially under the auspices of UNCTAD, could enable for a more inclusive dialogue between preference-giving countries and beneficiaries, and in the future potentially co-design. So I thank you very much for today, and I pass the word to, yeah, thanks.